Hello and welcome, my friends. In this video series, I'm going to show you exactly how I was able to earn a full-time income in less time than it took you to drive to and from work today. My name is Andrew Ferguson, and I run a company called Trading Options Daily, where my sole mission is to help 10,000 investors just like you on how to invest with stock options in only 30 minutes a day, all from your smartphone, so you can live your dream life. I want you to succeed more than anything, which is why I'm giving away my entire system for free here in these videos. So let's get into today's topic. So session number one, the basics, the fundamentals, the background stuff you need to know to understand and go deep into strategy. You need to know it because this is the basic rules of the game. Like otherwise, if you were playing Monopoly as a kid, you didn't know what you were doing and just grabbed the 500 bucks from the middle, with all the get out of jail free cards and declare yourself the winner, no one else would play with you. Like that's the consequence. You'd have no one else to play with. And the stock market has rules as well. They are incredibly easy to follow once you know them. So understand the rules of the game. You're here to learn, but most importantly, if you want to make money and use that money for whatever you want most in life, you might already understand why this is important. But for those of you who may be wondering if investing is actually worth it long term, we'll recap why it's becoming more essential every single day. And lastly, in this session, we're going to break down the tool we're going to use to create the financial freedom in our world. Stock options are kind of like if you had a piece of furniture from IKEA and it came with instructions. It's actually pretty easy to kind of put together on your own, right? But where people go wrong with stock options is where you buy a piece of furniture and you don't get the instructions. They're just left to figure it out all by yourself. That's when things go wrong. So maybe you've gone through this with a piece of furniture yourself, but it sucks, right? Like it does. But you don't have to worry because I've got the furniture, I've got the assembly guide in full here in this video series. We're at the first step of the journey. It's kind of like your first day of school. You're probably feeling a little bit excited, maybe a little bit nervous because you're worried about making new friends, having a good time. But don't worry, I'm here to get you dressed up, pack your lunchbox, give you a couple snack packs, get you on the bus, give you a full box of crayons, and get you going in school. You're taking that first step up the staircase together. And by the end of this journey, that staircase is going to turn into an escalator. You're going to be able to get on that, ride it up to the top without much effort. It does take a little bit of practice and some consistency, a little bit of discipline. But if airports have taught us anything, whether it's an option for a flight of stairs or an escalator, everyone goes for the easy ride up. Back to Monopoly. You need to learn the rules in order to play the game and ultimately win. The stock market itself, it's a place where buyers and sellers meet, right? It's a collection of exchanges and public shares are issued and held and companies kind of transact with each other. It's institutionalized, it's formal, it's physical, electronic, and they have a defined set of regulations. So it's kind of like a farmer's market where people are buying goods, people are selling goods. As investors, we want to get as much value for as little risk as possible, right? And there's just tons of cash in play. Like the US market, 28.2 trillion, Canadian market, 3.3 trillion, a little bit less than the US. So we know where the money is. We want to operate there. And how do we do that? Well, we just want to make sure we're on the right exchanges, being the New York Stock Exchange or the NASDAQ. There's also the TSE, there's a Shanghai, there's London. There's one for a lot of the major countries in the world, but I don't focus on those companies and I only trade on the New York and the NASDAQ mainly. So we focus on those two because there's more volume and more money in the market there. And if you don't think it's possible to make money in the stock market, you are wrong. People have done it, right? Here's two examples, some of the best ever. Ray Dalio, $20 billion from his bedroom in college. It just takes time and consistency. Maybe you haven't heard of Sweet Baby Ray. No, I'm just kidding. No one calls him that. It's just my favorite barbecue sauce for chicken wings. But if you haven't heard of Ray, maybe you've heard of this guy, Warren Buffett, considered the greatest investor of all time. And he even uses stock options within his own company, Berkshire Hathaway. His name's going to come up a few times because of the stature and some of his pearls of wisdom he's dropped over the years. This is one of my favorites here. The stock market is a device for transferring money from the impatient to the patient. So you're going to learn why patience is important and why it's going to pay off as we go through these slides together. And even if we don't get anywhere close to the legends, we have a fallback plan because the S&P 500, the top 500 companies in the US, has returned an average of 10% over the past 60 years. So all you have to do as an investor, make your money, save a little bit, invest it, 10% a year, put it on autopilot, cruise. But if you want a little bit more than that, right? A little more than 10%, the more you make, the more you earn, the quicker our money grows. So I've got an example coming up to illustrate this point, and that's where you want to live as well, above that 10%. How can you make money? The basic ways you can make money in the stock market, the first one's what most people try to do, but it's actually a lot harder than you think. And even the pros don't do this very well all the time. The second option is attractive because time usually works for the holder and it's a little bit easier to implement. And the third option is where we live and breathe, and it actually takes the best of the buy low, combines it with hold forever, and just juices it up a little bit. So if you plan on watching all these videos and think you're going to make a bunch of money right away, that is not just going to happen, okay? There's a reason why lottery winners go broke. The house always wins, except in Ocean's 11. That's a different story, but you get the idea, right? Gambling in the stock market is a quick way to lose a lot of cash. Why should we be investing? The battle that we're facing currently. Inflation is a big reason why we need to invest. Like, costs of goods are rising. Interest rates are rising. If we don't do something, the money that we work hard for ends up buying less and less every day. So you have to work more or be okay with having less in our lives. And you cannot save your way to wealth. Like, saving accounts are not the answer, right? This is like a rainbow of wealth right here. If you want to end up on the green strip of the rainbow, this is how we want to do it. We want to make those juiced up 30% returns if we can. And look at the difference in cash flow from 1.5%, which is the average kind of bank, like a high yield savings account, versus 10% versus 20 versus 30. Let's go get some cash for ourselves and give ourselves the life that we've always dreamed of. Another one of my favorite quotes here is, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't, or she who doesn't, pays it. When you give your investments time to build up, eventually they become to the point where they are unstoppable. And the only way you're going to make a lot of money is by making a little bit of money first, rolling that snowball and getting it going down the hill. But once it takes off, you don't have to push anymore. It just goes and just keeps rolling, rolling, rolling. So my question to you, do you believe it's possible? Like, once you believe it, you can do it, but you have to have that belief in yourself first. So if you don't believe, then it's never going to happen, right? And if you do believe, though, and you do have that confidence in yourself, this strategy and concept can change your life. It's going to take a little bit of time, but it can get there for you. It's going to happen at a different time for everyone. It's just planting a seed and then letting that kind of inception in your mind happen, let it flourish. When we have to go to a dream within a dream within a dream, or still even further all the way down and help Leo create that idea in your mind, but we're going to get there. So what are stock options? They are the tool you're going to use to create financial freedom in your life. And it is basically, a stock option is a contract between two people. It gives one person the ability to do something, and one person gets paid for taking on the risk of having to do something or have something being done to them. That is like the easiest way to kind of sum it up. And there's two types of stock options. We're going to get to know these because we're going to operate in one of them the majority of the time. Call options. The buyer gets paid to control 100 shares of stock from the seller. He wants the price, or she wants the price to go up. The seller gets paid to take on the risk of having to sell 100 shares of the stock to the buyer. This is good to know, but it's not where we're going to operate a majority of the time. The graphic looks like this. The buyer wants the price to go up for a call option. The seller wants the price to go down. That's how it works. This is what we're going to do. The second line specifically, put options. The buyer pays for the option to sell or assign 100 shares of stock to the seller. The buyer wants the price to go down. We, being the sellers, that second line there, make sure you read that twice, okay? We get paid to take on risk of having to buy 100 shares of stock from the buyer. The seller wants the stock price to stay the same or go up. The buyer wants the stock price to go down. We want to be the seller. Let that sink in for a second. You with me here? We're on the right-hand side. We are selling these put contracts, these put options, and we are benefiting when the stock price goes up. There's also some terminology you need to know if you're going to get through this. And after today's video, make sure you kind of review some of the things that you may be a little bit fuzzy about, because it takes time to sink in. Also, just make sure you subscribe and like the video if you're getting some value. That way you don't miss the next part of this video series. So the underlying, when you're talking about stock options, the underlying is the company or the stock itself that you're going to buy or sell. Sell is bolded there because it's important. You're going to sell a contract on. The price. The price is the current value that the company's shares are trading at. So if I'm taking an example right from my Interactive Brokers mobile app, which I use to trade on, this is what's going to look like in your app when you have it open if you use Interactive Brokers. I want to include real pictures so you're going to have an idea of like what I'm looking at, or if you use the same app, similar at least. This is my Samsung phone, and the iPhone is very similar, but it's just a tad different with some of the layouts. But I just want you to see this because this is what it looks like in real time. The price there of Apple at this kind of screenshot, Apple 167.73 for the actual stock price. More terms you need to know. Expiration date for options contract. They don't last forever. They have a defined end date. This is what part of it is what gives them value. Okay, we're going to talk a little bit more about how time affects options a little bit later on, but this is important to know. Expiration date, the strike price, the predetermined or agreed upon price you're going to buy or sell shares at. So if this is coming at you a lot, we're going to break it down. Don't worry. Make sure you go back and review this stuff. The expiration date here in this example would be February 18th, 2022. The strike price there, Down the middle, 140, 145, 150, 155. There's options there within the option chain. It's called an option chain. You have different kind of strike prices you can pick. A couple more here. You need to know the bid-ask spread, the amounts that the buyer and seller are willing to agree upon for each contract. Just like you're going to a farmer's market, someone wants to sell you something at a certain price. You want to barter with them a little bit more as the buyer, pay a little bit less. You know what I mean? And we want to know what the bid-ask spread is. Premium now. That's the cash that the buyer of an option contract pays the seller. So the buyer pays the premium, the seller collects and earns the premium. And in the options chain, when you're looking at this, right, on the right-hand side there, in the puts column, because that's where we operate, you've got the bid there, you've got the asks there, and then in between that, if there's a number in between, it's a spread. So the spread here between 3.30 and 3.35, the spread or the middle, as it's called in the option world, will be 3.2 or 3.32 or 3.33. That's where you make a deal in the middle there between the bid and spread. So putting it all together, if we're looking at this stock option contract here for Apple and the one that's highlighted in red, you'd be selling a put with a strike price of 155 on Apple. There's 29 days till expiration because of the February 18th. And this is obviously a little bit dated, but February 18th in the past. And it's 29 days till it expires. And you would get paid as the seller of this contract $217 because of the rule of 100. This is what I mean. It shows 2.17 there, but the rule of 100, every stock option contract is made up of 100 shares. Remember this basic math. So 2.17 times 100 equals $217. That's how that works. We will have some more help, and we need the math for later on as well. So you also have a different position for your put contracts. There are things called out of the money, which is contracts where the strike prices, remember what strike prices are now, go back and watch the video if you don't remember, but where the strike prices are actually lower than the current stock price. What I mean by this, it's in the green zone. If Apple's strike price or Apple's stock price here is 167.73, if you want to be out of the money, which is the good place to be for naked puts, and you'll learn why in subsequent videos, we want to operate in green, out of the money, where the strike price 160, 55, 50, 45 is lower than the actual stock price. That's out of the money, below the current stock price. At the money refers to contracts with strike prices that are equal to or nearly equal to the current stock price. This is what we mean. The strike price is equal to 165, 170, around that 167, 73. It's mainly just the option below and the option above. That is at the money, nearly equal in value. It's the orange zone. We don't want to operate there very often, maybe once in a very blue moon. We don't want to operate there very often. We want to be in the green. And there's in the money. You know this too, just because you don't want to be in this zone if you're selling put contracts, okay? This is where strike prices are above the current stock price. And this is the red zone. Anything in this example would be 167 again for our stock price. Above that, we're out of the at the money zone here. We're at 175, 180, 185. The strike price would be higher than the stock price. We don't want to do that. So to summarize again, it's color-coded for a reason. Danger, Will Robinson, danger. Little Lost in Space reference for you there. But I do like movies, can you tell? But seriously though, we need to be in the green zone to maximize profit and minimize risk. That's the sweet spot. We want to get a good return for as little risk as possible. You stick that green zone and you will learn why in a second here. Okay, the first time I heard this stuff, I was all over the place too, and I was just trying to keep up. If this is how you feel right now, take a second, leave a comment, spit out some questions. We're gonna get through this, I promise, okay? A little bit more to wrap up this section here. I wanna bring up this term, volatility and the VIX. You're gonna see it again, but just keep this in mind, okay? Volatility can be thought of as a measure of risk. And high volatility means that the stock price or the stock market is going to fluctuate greatly. Low volatility means that the price of a stock will fluctuate minimally. And there's examples for both of those. There's really volatile stocks, there's less volatile stocks. The market can be volatile as a whole or very low volatile as a whole as well. So volatility in the VIX. The VIX itself is a measure of volatility for the entire stock market. So it goes and it acts as a fear gauge of the market, and it usually moves opposite to the chart of the S&P 500. If there's very high volatility, usually that's when the market is selling off. So the VIX is opposite of the stock market as a whole. Okay. Volume. Volume refers to the amount of shares traded each day for a specific stock, index fund, other product in the market there. And volume can really help because you can use it in your technical analysis when you're looking for support, resistance, and just doing your kind of research in the chart to get to the point where you want to go and make your technical kind of analysis to get the stock price you want from the chart. So if that seems like a lot, and that's just part one of our video series here, go back through it, reread it, digest it. Make sure you tune into next video number 2, where we're talking about the good stuff. The stock hacking strategy that I use, laying it out. You have the terminology, you have the basics down now. You understand the rules of the game. Now, when I explain to you what I do, you're going to understand, oh, that makes sense because of this. This makes sense because of that. So make sure you subscribe to the channel. Make sure you like the video. Make sure you stay tuned for the next one, rolling out this video series about how you can make a full-time income in less time than it took you to drive to work this morning using stock options. The next video in this series can be found right here.